In the year 2008, the world teetered on the brink of a financial abyss. In the United States, a housing bubble had been growing, inflated by the risky lending practices of financial institutions. Banks and mortgage companies, driven by the prospect of high returns, began to offer loans to borrowers who were ill-equipped to repay them. This lending frenzy led to an unsustainable surge in property prices. Homes that were once affordable were now priced out of reach for many, leading to a market saturated with overpriced properties and underqualified buyers. Government policies too played a role in fueling this bubble. Regulation was lax, and warning signs were ignored. This combination of risky lending and lack of oversight created a ticking time bomb in the housing market. And then the inevitable happened. The bubble burst, property prices plummeted, and the loans went unpaid. As the bubble burst, the shockwaves were felt around the globe, marking the beginning of the 2008 financial crisis. The crash was not contained to the United States. It sent a ripple effect across the world. Just as a single domino can topple an entire line, the financial crisis was no different. It spread, reaching the shores of the United Kingdom, Germany, and India, underlining the interconnectedness of our global economies. The United Kingdom, with its world-renowned financial hub London, saw banks crumble under the weight of the crisis. The collapse of Northern Rock, a prominent British bank, was a stark indicator of the times. Germany, Europe's largest economy, wasn't spared either. It suffered its deepest recession since World War II, with countless jobs lost and businesses shuttered. And India, an emerging economic powerhouse, also felt the shockwaves. Its robust IT and outsourcing sectors took a hit, leading to job losses and a slowdown in growth. This was not just an American crisis anymore. The crisis had now morphed into a full-fledged global recession, sparing no country, no sector. In the face of unprecedented economic turmoil, nations rallied to respond. This crisis was not just America's to bear, but a global reality, prompting collective action worldwide. Governments played a pivotal role in responding to the crisis, intervening with sweeping policy changes and bailouts aimed at economic recovery. The United States led the way with the Emergency Economic Stabilization Act, pumping hundreds of billions of dollars into the economy. Across the pond, the UK's government nationalised some banks and provided financial support to others, a move mirrored by Germany. Meanwhile, India, though less directly affected, took proactive measures to safeguard its economy. Central banks worldwide, in a bid to stimulate economic activity, lowered interest rates and implemented quantitative easing. These significant steps were the world's collective effort to steer economies away from the brink of disaster. The road to recovery was long and fraught with challenges, but the world pressed on. Despite the hardships, the world proved its resilience in the face of adversity. The 2008 financial crisis left a lasting impact on the world economy. This seismic event sent shockwaves through global markets, causing widespread economic turmoil and hardship. The crisis altered the financial landscapes of the United States, the United Kingdom, Germany, India, and beyond, leaving no corner of the globe untouched. The long-term effects of the crisis were profound and varied. On a macro scale, economies worldwide experienced slowed growth and increased unemployment. Societies grappled with the consequences of decreased public spending as governments sought to stabilize their economies. On a personal level, individuals faced job loss, home foreclosures, and a sharp decline in personal wealth. However, like any great challenge, the crisis also offered valuable lessons. It underscored the critical importance of financial regulation and risk management. It reminded us that unchecked speculative practices can lead to catastrophic outcomes. It illuminated the dangers of an over-reliance on credit and the fragility of financial systems built on risky investments. In the aftermath of the crisis, nations worldwide began to rethink their approach to economic policy. Regulators sought to strengthen financial systems, implementing stricter controls on lending practices and pushing for greater transparency in financial transactions. The crisis spurred a renewed emphasis on economic resilience as nations strived to build economies capable of withstanding future shocks. The lessons learned from the 2008 crisis continue to shape the financial practices of today. Banks and financial institutions have become more cautious in their lending, and individuals have become more mindful of their financial decisions. Governments worldwide have recognized the need for stronger regulation and oversight to prevent a similar crisis in the future. The 2008 financial crisis was a stark reminder of our economic vulnerabilities, a lesson in resilience, and a call to action for a more sustainable future. As we move forward, let's remember the lessons of the past and strive to create an economic landscape that is robust, resilient, and equitable for all. Before we wrap up this deep dive into the 2008 financial crisis, we want to remind you that your engagement and support mean the world to us. We're here to bring you insightful content, to spark conversations, and to learn together. If you found this video informative and valuable, we encourage you to hit the like button and share your thoughts in the comments section. Your feedback helps us tailor our content to your interests and needs. And if you haven't already, don't forget to subscribe to our channel, CreateGreat. We have plenty more interesting content on the way, and we'd love for you to join us on this journey of learning and discovery. Together, we can strive to understand our world better, appreciate its complexities, and envision a more sustainable and equitable future. Thank you for being a part of our community.